Well, hey there, everyone, and welcome to today's VIP Trade Room with Roger Scott and Matt Horton. My name is Raleigh White, and I'm coming to you live from Austin, Texas, and I'm going to be your moderator today. Now, in today's session, Roger is going to be covering a bunch of critically important information with the focus on, or the continued focus on seasonality and how we should be using it in our trading. And in today's agenda, he's going to be talking about the different types of trades depending on seasonality periods. He's going to be talking about strong, average, and weak seasonality trends and how to deal with that kind of trading environment. He's also going to share with us an ideal option strategy for each one of these environments, whether it's strong, average, or weak. He's also going to take a look at today's daily watch list, and he's going to be looking for those that have seasonal opportunities, and then he's going to share with us the appropriate option spread for each one of those entries. So, a bunch of good stuff here on this continuing education series on how we can use seasonality to our advantage. Now, if you've got any questions during Roger's presentation, just type them in the chat window and we'll address them periodically throughout the session so as not to interfere with Roger's presentation. Now, for those of you that may not have been with us this morning when Roger opens the markets, he greets the markets every morning at 8 o'clock and tells us, what he sees happening and kind of sets the stage for us. And the overall theme for today, from Roger's perspective, is that the market remains up on broader investments. He's really hammering home the fact that he really likes that money is flowing into more diverse areas and not just piling in to the MAG stocks. He also noted that about 64% of companies now are above the 200 moving average, and that's up from 50% from last week. So we're seeing some nice diversification there, and there continues to be nice alignment between discretionary and blue chip stocks. Now, as far as today's catalysts are concerned, and you know what the catalysts are, folks, those are things that can be market moving. The information is known, but the regular session wasn't open yet, so the market hadn't responded to it yet. The big one was the producer price index, the PPI. It came in up 3.3% year on year, and that's the sharpest rise in 3 years. Now, there's a number of ways it has the potential to impact what's going on, but the big one was that Roger strongly believes that this could potentially delay a September rate increase. Now, prior to this report coming out, the thinking was is that at least a quarter point is baked in with about a 98% accuracy. And as soon as this report came out, Roger said, I think that's probably dropped to about 7%. So we're just going to keep our eyes very closely peeled on that one. Now, the jobless claims also came in, and they were about where things were expected. So, but no real impact as far as what we saw. Crude oil appears to be bottoming out. It's staying above 60 and hanging in right around 62, 63. And once again, it seems to just be stabilizing, which is good news to transportation industry. Anybody that really depending on the price of crude to drive their costs in either direction, either positively or negatively. Bonds were also holding on to gains below the 200 moving average. The SPY and the SMH were both hanging right around the 8 moving average area. The Dow was chopping sideways, and it's sitting in a range where it basically looks like it's just waiting for a breakout, but nothing significant there. The star of the show this morning was the QQQE, which was moving significantly higher, showing the investment that we're all like seeing in small cap technology. Now, once again, these are not, these are not dollar stock plays. They still have significant market cap, but they are smaller cap. And once again, this is money that's moving away from the MAG stocks. He was also taking a hard look at China, and we see that the Chinese large caps were cooling just a little bit, but they were still up. And then, of course, the other thing that was just weighs on the market is the ongoing impact of tariffs. A lot of people just waiting and seeing what the impact is going to be, not only on costs, but how that might start driving and impacting the labor force. And of course, then there's the discussions with Russia and Ukraine, which are going to be happening on Friday. So this is kind of background information. As far as Roger's small cap watch list is concerned, he identified, and I'm just going to put this in the chat panel for everyone to see. He identified four stocks, four ticker symbols that met his criteria: IVP above $1.45, XPON above 360, and Roger really liked this one. He starred this. As a matter of fact, he actually had a lower entry, but it was already he had pushed through that pre-market. AERT above 145 and XOS above 615. Now, the one thing I just want to mention about these small caps, and I think you all know this, but I want to reinforce it. The key to his selection process is price action and volume. Okay, because small caps are not market dependent. So what the broader market is doing doesn't seem to have an impact on them. There's no RSI really to utilize in making a decision because, the large institutions aren't even looking at small caps. And he also reminded everyone that we should only be looking at trading these during normal market hours. When we're in the room together, we're pre-market and we see this opportunity, but getting into those potential small cap stocks should happen during more normal market hours. He also gave his daily stock watch list, and I'm just going to put this in the chat panel so that everybody sees this as well. And once again, as you know, Roger has a very specific and highly disciplined way of looking at, what is going to go onto his watch list. And then as the day progresses, once again, it's before the market opens, he makes modifications and changes and will do an update here around noon. So the VIP session is always noon, kind of a midday. It's a good way to just to check and see how things are going. But anyway, those are the kind of things that Roger shared with us, and we had great discussion on this morning. He does this every day from 8 to 9 a.m. Eastern time, and he wraps up just about 30 minutes before the markets open. So just to recap a little bit, once again, you're here at the VIP trade room with Roger and Matt. The agenda for today is going to be continuing education on seasonality, in particularly talking about the different types of trades you can take depending on the seasonality period, whether it's strong, average, or weak. Each one of those sets up a unique opportunity. He's also going to talk about the ideal option strategy for each one of these environments. And he's also going to take a quick, fresh look at the daily watch list, see which one of those might be setting up for a possible seasonality opportunity. And then he's going to share with us what he feels the appropriate option spread should be for each one of those entries. So a bunch of great stuff going on today. Once again, this is part two of a discussion on seasonality and how you can use seasonality to your advantage. The session yesterday was fantastic because, for those of you that were here, Roger said seasonality and the information that's provided is dangerous on its own. Okay. It always has to be looked at and considered in context to other things that are going on, in particularly some technical indicators that you can use along those lines, and obviously other factors that he uses when selecting what are the best stocks to focus on. So just a great session. And as we also just mentioned a few minutes ago, the key reports that were just weighing on his mind today was the PPI. And when the PPI came in up 3.3% year on year, different, he was like, whoa, baby. The first thing that came to mind was, man, this is going to put a crimp in and potentially any Fed activity around lowering interest rates. As a matter of fact, the contrast was fairly pronounced because before the PPI came out, the consensus was about 98% that in September there will be at least a quarter percentage cut in the rates. But as soon as the PPI came out, Roger said that 98% is probably 7% now. So we'll see, but that certainly is kind of a boat anchor. And in his particular mind, from his perspective, it's a direct reflection of the impact that tariffs are having on the cost that producers are having to incur as they look to make their goods and materials. So that was a big one right there. The jobless claims came out and they were just about where expected. As a matter of fact, Roger says he always finds it suspicious that those numbers seem to be around 220 to $225,000 every single week. He says going back 30 years. So he said as long as people are going to be examining things, let's take a look at those jobless claims. But anyway,
Actually, not the last 30 years, as long as I've been doing the show,
oh,
about
hey,
7, 8 years.
Roger.
Hey, how are you? How are you? Not 30, but long enough. Not
Long
30,
enough. I'm
long
sorry there,
enough, long
buddy. I
enough.
was just looking at my notes, but Roger, I was just giving a little bit of a background there. I covered the agenda. People are excited here. We got day two on continuing education, on how seasonality, can impact your trading. So people are excited about this. Got a bunch of people coming in. Good session this morning. Roger, the first thing I always like to ask you, between what you thought about the markets before the open and where we are right now, any surprises from your standpoint?
Yes, yeah, huge surprise actually. Funny that you mentioned that. Today and I want to spend a little time on this. And just to show you how powerful, really show you how powerful uh, the tools that we use are and how we stick to them. Well, at least how I stick to them, regardless of good or bad. By the way, good morning, Kevin, Richard, Devin, and Araj on YouTube. Let me just say hello to everybody here. And Kevin, Sean, Javad, Jill, Matt, Wild Ranger, Stephen, Gus, David, Ken. Good morning, Ken. Cyrus, we can't do the music, Ken, because we host on YouTube and YouTube has a copyright thing. So they think like we're pirating somebody's music if we're
Hmm.
doing, which is ridiculous, but bureaucracy. What are you going to do? Cyrus, Richard, hello, Richard. Moondog, SB, Paul, Sergey, Ira, Maggie, Peter, Shannon, Kai, Steven, Mike, Ken, Joel, Mike, Mark, iPhone. Everybody's here. I love it. And if I missed your name, I am not doing it on purpose, just a lot of people. So, yes. So, generally speaking, let me just share my screen. And I want to spend a little time on this. It's not letting me share my screen for some reason. I have to send a request. Because you're sharing, Raleigh. That's what it is. Or Matt. Somebody share.
Yeah,
There you go.
there you
That's
go.
it. No, that
There
was
you go,
Matt or
buddy.
something. Perfect. Okay, so check this out, guys. So when the market opened, first off, before the market opened, so let's go back a little bit. The market, the market looked just fine this morning. There was nothing going on. Then we had the PPI report. The PPI report was really bad. Matter of fact, this was the worst surprise. This was the worst surprise since 2022. Okay, since
Right.
2022. Now, I'm not being perfect, John. Excellent. I'm not being I'm not trying to be dramatic. I'm just being factual. This is the worst report since 2022. That is very, very significant. Okay, that is really, really significant. And that's not great. It's telling us that what it's telling us, and I don't want to get too deep into politics and all that, but what it's telling us is that the tariffs are starting to impact the producers. And not usually, always, as you guys know, basic supply and demand, producers and then consumers. First the producer gets hit, then the consumer gets hit. So that's a big problem. That's a big problem, and that undermines the whole conversation of interest rates going lower. Because remember, interest rates are supposed to be going lower when the economy when the economy to keep it moving, not it would be the opposite effect.
Right.
So now, again, this is where we get a little bit political. I don't know what Trump is going to say. I don't know what the market's going to do. I don't know what the reaction will be. But the market opened this morning, and pre-open, it started going down pretty good. And if you look at the bond market, the bond market is falling off a cliff here, okay? And meanwhile, while we're seeing all that, what does the stock market do? So the stock market just starts roaring higher. Now, think about this. The market opens at 9:30, right? The market was going highs, and I mean ripping, 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 okay? For an hour and a half. Now, while the market is ripping, while the market is ripping higher, and this, okay, see the purple line? That's the market. This is the same thing. This right here. See this right here? This? That's the purple line right here. Okay? This is the S&P 500. And this is the Vold. Now, for anybody who's ever had any doubt how well this Vold works, how well market internals work. So for 90 minutes, I'm getting emails from folks. Roger, what the hell's going on here? I'm like, I'm stumpled. I'm stumped. And I was posting this all in the Telegram, multiple Telegram channels. Like, I am completely stumped by this. The Vold is going straight down. I mean, this is not, you cannot get a better trend than this, right? Where does the ADD open? Does it open negative 1500? Hell yeah, it opened up at negative 1570. And what has it been doing? But for 90 minutes, the SPY just kept going straight up, straight up, straight up, straight up. And then what happened? It completely caught up. It's diverting again right now, by the way. And what is the Vol doing? Going down. So yes, I was really surprised. I was really surprised. And I was telling everybody, like, I'm really surprised. Richard says 99.9% of the time. Richard, I was really surprised because this is really bearish. This is really bearish. What was I writing to you guys? What was I writing to you guys? Thank you, Tony. I'm sure Raleigh will repost all those later.
Mhm.
What was I saying? This is not normal. This is not, don't go long here. Don't go buying. Were we buying anything? I was surprised. The only thing we have is long positions. I'm like, this is not. So yes, I was extremely surprised for the first 90 minutes, and then everything started making perfect sense. So, and I told you guys, so I gave you, and I could talk about this. I gave you guys a bonus trade. Well, no, I didn't give you anything. Clyde, yes, Clyde gave you a bonus trade right here. Look at that guy. That's him this morning. He's very happy. He's very happy. So he gave you a bonus trade this morning to buy a put about an hour ago. Yes, it was a good time actually. An hour ago. And now, why did Clyde tell you to buy the Russell 2000 and not the SPY? Can anybody tell me? See how we're putting everything together from all programs? He's a Scottish fold. He's a Scottish fold. I have two Scottish folds. Yes, interest rates rise. Thank you, interest rates. And what's the most sensitive sector to interest rates? The Russell 2000. I told you this many times. So now what, and did the Russell, so look at the S&P, right? And then look at the Russell. It opened here and then it never did this. It just went straight down. And what did Roger do? Well, actually, I didn't do anything. It was all Clyde. Gave you a nice trade. So we were looking at market internals. So what were we doing? We were doing exactly what I tell you every single day. We were looking at market internals. We were looking at how they were going straight down. And they're still, by the way, they're still going straight down. Nothing changed. And we were just like, wait, we were looking at the small caps. Small caps were cooperating. So I used the concept. I know it's a really strange concept. I've never talked about it before. It's called relative strength and relative weakness. What was the weakest index today? The Russell 2000. What did I short? The Russell 2000. Did we do everything by the book? I'm going to ask you, did we do everything by the book? And was I warning you and telling you this throughout the entire time? Ruthie says yes. Wild Ranger says yes. Lewis says yes. Tammy says yes. Abe says yes. John says yes. Solaire says yes. Jill says. The point is, I was telling you this throughout the whole broadcast, the whole in the free Telegram channel, in the public Telegram channel, and in the Trading Pit channel. So my point here is, we were no, Jody, just doing it for a long time. That's all. But thank you, I appreciate it. So the point of the matter is, we were completely following everything we've learned here. We were completely ignoring. We were completely ignoring the market, and we were waiting for the market to catch up to market internals. And one of the things that really got me this morning, and I'll tell you what it was. And I hope you I want you to understand. I'm not having I hate to say I told you so moment. That's not what this is. I want you to understand what the red flag was to me. If I saw Vold going down, and the ADD wasn't as bad, if it was say like negative 500 or 400, I might have not been so baffled. But this is telling us that we have a hell of a lot of stocks trading below yesterday's low. Stocks don't just go from trading below yesterday's low to trading above today's high. They just don't do that. I mean, it's not common. It's not. It's not in every. You may think it's common, but it's not. So this stayed here, and this kept going down as the S&P kept going up. But what eventually happened? Well, here's what eventually happened. You could see it. It happened right here, and it happened again right here, and it's probably going to happen again. But look at this clean trend on the Vold. You have the internals. You have tick facing to the downside. Tick is not really instrumental in this analysis. This is more instrumental when we at the open and when we have solo candles. And let me tell you, it didn't disappoint. I'm looking at 750. We got 1315. So my question to you guys is, how are you doing right now on this trade? It's one of the few questions I'm going to ask you. Up 16%. Let's see. Petro's up 16%. Up 16%, 16. So everybody who followed directions is up 16%, 23%, 11%, 25%. Okay, well, I guess we're all over the place. 20%, 71%. Jim missed it. Mea culpa. What are you going to do? All right, so it's worthwhile. Good. Try to get out of that trade before the end of today, or when the Vold starts getting choppy. Okay, guys? So I'm just giving you heads up. Get out of that trade when the Vold stops going down and starts maybe going up or just consolidating. Okay? Don't look at how much you're up or down. Just get out of the trade when the Vold stops going down. Okay? All right. You're welcome. Now, another pleasantry before we get into today's lesson. I don't know if you know this or not, Raleigh. Oh, actually, you were there. You were there this morning.
Yeah.
So I gave folks some stocks this morning, and I've been getting so many positive emails. I only post like 1/10 of all the testimonials I get. I'm not going to post all of them because you guys would be reading testimonials all day instead of trade advice. But what I wanted to show you was this. So this morning, I gave you the following stocks. I told you to buy AERT if it goes after market hours above 145. Didn't go above 145, AERT. I told you to buy XOS if it goes above 615. Oops, wrong ticker symbol. Excuse me. This is what was the ticker symbol?
XOS.
XOS. Oh, SOX. Sorry, it's been a long morning. XOS. Here we go. I told you to buy this if it goes above 615. It did not. I gave you IVP. I told you to buy IVP if it goes above 145. It did not, which would put it right above here. I wanted to make sure I was watching out for you. I wanted to make sure you buy it above the 100-day. And I gave you XPON. And XPON opened, and I told you to buy XPON at 350 or high, above 350. And look at this. It opened up at 316, 3 something. And by The bottom line is it went to 543 and I got a lot of nice testimonials. That's what happened. Okay. So these things really work well. And the rules, it's very important that you follow the rules, folks, because if you don't follow the rules on these trades, you're going to get yourself into a bunch of, it doesn't work that way. It doesn't work unless you follow the rules. So the best thing to do is set an alert at the level I give you, wait for it to trade above that level, and then get in by like a penny or two. That's the best way to do it. Okay. Don't just blindly buy these stocks at the night morning session, the overnight session. Don't do that. Okay. It's a big mistake. Please don't do that. Okay. Big, 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 big mistake. And now I'm going to give you another lesson. Now, this is important because this will illustrate a time spread properly, okay? Because I know we've been talking about time spreads a lot, and we actually have time today. I don't have that many stocks on my watch list in comparison. Yeah, Glenn, just watch the replay if you get a chance. If it goes up to get out of the Vold, you should be watching the Vold market internals. If you have TC2000, it's T2104 here. T2104. That's, see right here? That's the Vold right here. Okay. Right here. This red bar right here. Let me just move this to the side. So I want to show you guys, and sometimes when I do real examples, it helps out a lot. So I want to show you this. Where you get these time spreads from. What do you mean, administrator? Where do I get these time spreads from? I explained to you. I did a whole thing about it. So Cisco. Cisco. If you have any questions about the time spreads, feel free to send me an email. Okay. So Cisco had earnings last night. Okay. Cisco had earnings last night. Do you have a question about, if you have a question about debit spreads, administrator, please feel free to ask. Okay. So earnings came out right here, this bar right here last night. Okay. Before earnings came out, we bought a 71 call right here. Excuse me, we sold a 71 call and we bought a 71 call that expires next Friday. You see how this call costs 24 cents right now? Okay, so let me ask you an interesting question. It has 8 days to go, right? Okay. What happens, just follow along with my analogy. It's 24 cents right now. It's only 24 cents. 24 cents. It's all it costs. What happens if Cisco goes back right here to 72? How much would this 71 call be worth? About $1.50. It's a pretty good return, right? What if it goes to 75? That's a $4. It's now 24 cents. Now, am I recommending that you buy this right now? No, I'm not. This trade is done. But let me show you the trade, okay? So this one was about, yesterday, this option was about $1.75, okay? And this option right here was about $1.95, okay? This was $1.95. It was almost $2 yesterday. And this was $1.75 right before the close. You can't do it next week, Cyrus. It won't fall, you won't have the disparity. You need to have, this has to be at least 40%, implied volatility has to be at least 40% more here than here. You only get that before earnings. So you can't do that next week. I wish you could do it next week, Cyrus. Okay? So yesterday before earnings. Earnings were right after the close. This option right here was $1.75 and this was $1.95. Okay? Big, 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 big difference. So I used this option right here. I used this option right here to finance this option right here. I sold this one and I bought this one and I paid 20 cents for it. 175, 195. I don't remember if those were exact numbers, but this was 20 cents higher than this. Okay? Now, this morning, we offset it for about 30 cents, 28, 29, 30 cents. Okay? The same option, which is a 50% return. Okay? Because this started losing volatility because earnings were over, and this started losing value because it's 71 and we're at 69, and we opened below 70. So I took advantage of this option being 40%. The options on this thing were 40% more expensive because of implied volatility than the options on this one right here. And they both experienced a volatility crush. And as a result, I was able to get out. But let's say I didn't get out. Let's say I got stuck. Okay, I can right now wait till the end of today, and I'll be able to get this for 20 cents. I would break even. But let's do a better idea. Let's say I hold this till next week. If Cisco goes back up, it can be worth $3, $4. My cost was 20 cents. I already made 50% on it just overnight by this volatility crush. Why can Cyrus not do this next week? Because you don't have a 40% disparity between the expiring week and the following week unless it's earnings and unless it's a really hot stock. There's other things that need to jive. That's only one. There's two things that need to jive. So you don't have that. You don't have that, Cyrus. I wish we had it. We don't have that. Now let's take a look at applied material real quick, right? All right, let's take a look. Survey says I had a session about it last week, Petro. Okay, let's continue. So let's just say that right now we were closing around 190. Okay. And look, okay, so huge, way more than 40%, Cyrus. Look, we're in the 145 percentile here, and we're in the 50th percentile. Do you guys see how, look at the difference between implied volatility? Do you see the difference? Next week, Cyrus, you're going to get babkas. You're going to get this disparity. See that? You can't do it next week, Cyrus. You can only do it right before earnings. So right now, implied volatility on this week's options are 3 times more expensive than right here. And this is not like according to Uncle Roger. This is just math. Look at the implied volatility. You see 147, say it's 150, and this is closer to 60. That's way more. There's a much more than 40% difference here. So yes, it may work, but there's another condition it has to satisfy, and I talked about it, and I'm not going to get into it right now. And actually, you know what? I should get into it right now because we're trying to put that into data miner. And the other thing is how many times since earnings started coming out on this stock, how many times do the options price in the expected move? How often does the actual move overcome the expected move? I want the expected move to be bigger 80% of the time. I want it to have a volatility crush, and I want this to be crushed. I want a double whammy compared to this. Petra says, what's the risk of doing that? I already told you, Petra, 20 cents. The difference between what you sold this for and what you bought this for. So let's just say we were doing it right now. I'm not doing it right now. I don't even know if I want to do it, but I'm not even going to think about this till the last half hour of the day. But let's just hypothetically, $3, $3.75. So it would cost you 75 cents right now if you were to do it right now. Okay? 75 cents. Actually, 180. Yep, 75. Either this one. If we do the 192.50, let's see, 195, 570, yeah, 75 cents. Because this options are all there. Look at how they're all priced the same way. So you got 75 cents. I'd like to pay 35, 40 cents. We'll see what happens at the end of the day. Also, I have to see if applied material fits the criteria. That's your risk if you do it the right way. So what I'm trying to do with data miner right now is I'm trying to take data miner and I'm trying to put this data into data miner, not the implied volatility, but the how many times the expected move via implied volatility compared to the actual move is off, because I want to have a double whammy volatility crush. And if you guys are understanding what I'm saying, you're either really good at options or I'm doing an amazing job of teaching you this stuff, because this is pretty advanced stuff. We're talking about volatility levels and I'm trying to make this as easy as possible, but we're getting into like level 5 strategies here. Okay? This is a professional type of, this is not something most beginners do. Okay? But this is pretty stuff. So let me ask you one more time. How's that IWM doing now that it's breaking lows on the day? Is it treating you well? Good. Good. Excellent. That's what I wanted to hear. All right. Looks like we have a bunch of satisfied customers. So now what I want to do is I want to show you something about seasonality. Remember I was telling you, thank you guys. Remember I was telling you guys how seasonality is your best friend if under the circumstances of, and by the way, Volt is still going down. I told you that if the technicals align, okay? So I'm going to do something really cool for you right now, okay? Go ahead and I'm going to tell them to exit right now of that trade. 1 second, Raleigh. Let me just tell them to exit, okay?
Yeah, no problem at all.
It'll just take a second. Clyde thinks you should exit the IWM spread, take 20% profit, and send Uncle Roger a nice email. That's what he says. What do you guys think about that? Does that sound kosher? Or do I ask for, see, all Clyde wants is catnip and I want emails in return. See how I don't ask for much, right? Okay. So I'm going to show you guys something really cool, and this will kill 3 birds with 1 stone. What I'm going to do, Matt, I think you're going to get a kick out of this, Matt.
All right.
I'm going to show folks, I'm going to give folks stocks on my watch list, okay? And then we're going to say, okay, let's assume seasonality is really good. Let's assume seasonality is really bad, and let's assume seasonality is okay. How would you reposition your position based on that, assuming all else is good? Wouldn't that be good? That way, they'll have like a 3 hypothetical examples of what I would do in 3 different circumstances. Don't you think that's pretty cool?
Yeah.
All right, let's do that. And administrator, you asked me how I learned about this trade. It's just a calendar spread during earnings. This trade's been around for 80 years. Remember, it's not the trades, folks. It's how you use them. Context. Time spreads are not fun, but when you put a little thing on it right around earnings, they become very, very interesting. Very important. Because I'm sick of you guys getting taken during earnings. Earnings, buy options. The worst thing you can do is buy options. I cringe when I see you buying options during earnings, because you're doing what are we doing during earnings? We sold that Cisco call. Look at what you're doing. Think about look at what people are doing right now. Buy applied material option. Look at this. Look at what you're doing right now. You are literally, let's say you take somebody's advice and you buy a stock before earnings. I think maybe if they see it like this, they'll stop doing it. You're literally paying 3 times more what the option's worth compared to what it usually costs. Look at the implied volatility. That'll raise the price of the option 3 times. I'm selling this thing. You're buying it. My win rate is 85%. I'm buying this one, not this one. Think about that for a minute. I'm doing the opposite of what you guys are doing, and my win rate is 85, 90%. Stop buying stocks before earnings. You're paying up the wazoo in implied volatility. You're getting ripped off. That's what you're doing. Okay. All right. Good. 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 All right. Let's continue this exercise. So while I'm doing this, take notes of the stocks because these are actual stocks that I have on my watch list right now. Okay. So these are not hypotheticals. The only thing hypothetical is which options or strategy I would employ. But these are all stocks on my watch list right now. Kava. Don't tell Graham about this one. He likes to eat here. It's breaking down. I learned I didn't even know about this stock till Graham told me about it. But he said it's a really good Mediterranean stock, and I really love Mediterranean food. But this thing. Remember, food prices are getting more expensive. PPI, food prices. Who do you think is going to suffer? You know, your restaurant's not gonna. They are gonna eat a lot of the profits, but they're gonna be suffering. So let's just say, I'm gonna give you guys a couple of scenarios right now. This is gonna be fun. Let's say hypothetically speaking, right now, okay, seasonality is really bullish on Kava, really bullish. I go to the data miner and seasonality is really bullish. How would I trade this? Anybody wanna? Before I give you the answer. Does anybody want to answer what strategy I would employ? Really, really bullish. What would I do? But the technical action is really bearish. It's on my short list. It's on my short list. Okay? It's on my short list. This is why I wanted to do it this way. A vertical put spread. Well, what kind of a put spread? So, okay. So let's start here. Maybe this will be less confusing. Maybe this will be less confusing. The stock has a strong downtrend, so I think it's going to go down technically, but seasonality is up. So I have a boat that I want to sail south, but the wind is going to be at my back. So the odds are it's going to stay right here. It's not going to go down. The odds are it's just going to stay here or just going to consolidate and not do anything. So in light of that, in light of the fact that it's more likely or not going to consolidate around here because seasonality is bullish and the stock is bearish, hypothetically speaking, the seasonality, what would I do? What can I do? I could do an iron condor. Thank you. I can sell a bear call, a bull put spread and a bear call spread. I can do an iron condor. Okay. Very important. If I didn't have data miner, I would have probably just bought a put. Okay. Because it's got a strong downtrend. Let's try this again. TTD. So let's say TTD is declining. Oh, you guys are going to love this one. You're going to love this one. Let's see how many people get it right. So TTD is declining. I'm very bearish. It's breaking down right now. And it was breaking down last few days. And those are all high volume bars, and we have good volume. Okay. I doubt anybody's going to get this one right. You guys really have to know what you're doing to get this one right. So we have a lot of volatility, and let's say seasonality is neutral. What trade would you do? Hey, somebody actually got it right. Somebody actually got it right with a question mark. Hey guys, look at the ATR on this stock. Ruthie got it right. Vivek got it right. I would straddle strangle the crap out of this thing. Why? Look at the volatility on this thing. 667 $6 and 67 cents. I can go and buy calls. I can buy the 51 calls for 50 cents on this thing that expired right here, that expired tomorrow. Okay. And I can buy puts on this thing, 50 puts for 50 cents that expire tomorrow. That's $1. This thing moves $6.67 a day. A day. A day on average. Pretty clever, huh? Pretty clever, right? Shit, I may do that. That'll look so good. I may want to do that in the pit for you guys as a bonus today. Sorry, I didn't mean to curse. I'm just thinking, wait a minute, that looks like a really good trade. Um, yeah. Look at implied vol. Look at average true range. $6.67. Look at the cost of a strangle or a straddle. Dollar 50. Maybe I will, Gregory, but I'm going to wait till the end of the day. I don't see a need to do it right now. It's just flopping up here. Premium gets better. You made the trade iPhone, 47 cents sold, $2. Good for you. All right, let's continue. Are you guys enjoying this exercise? Is this opening your eyes to like the different ways you could trade based on seasonality and technicals? Is your mind, do I have your mind turning a little bit, like stuff working up there a little bit? Hmm. See, Raleigh, I knew this was going to be a good idea because this gives them all the different, like all the different scenarios.
Yep.
People love that's good. Okay, next one. IoT, that's another short. Well, it's a grinder. It's a grinder. Let's say that seasonality is neutral on this one. No, it's not going to be a straddle or a strangle this time. You're welcome, Abe. So what do you guys say? What do you guys say? What kind of a trade? Neutral seasonality, grinder, not high volatility. What would we do? What I would probably do on this asset, if honestly, I would probably sell a bear call spread. I would sell a bear call spread. In other words, I would take premium out of here with the assumption that this is going to consolidate or just gently come down here or just sit here. So I would probably go a little bit out of the money closer to the 8-day EMA and see if I could take 50 cents on a dollar premium. But that's what I would do over here. Okay. And I would go out about 2 weeks. Okay. 2-3 weeks. Okay. Let's continue. Okay. So one thing about me, I'm not a butterfly guy. You know, I've talked to a lot of professional traders and I know a lot of guys who just do butterflies all day and they adjust butterflies all day. But it seems to me, and again, please, I'm not the encyclopedia of trading, but it seems to me that the guys that do the butterflies and those type of strategies, they work those trades all day, and that's like their thing. That's what they focus on, and a lot of them are really really good at it. I know we have one guy here, Jeff. Jeff, he understands a lot about those type of trades. And we also have somebody in-house. His name escapes me, but we have somebody here who specializes in those type of trades. Those are very different type of trades. The type of trades that I stick to are straddles, strangles, calendar spreads, and Chris Pulver. Yes, Chris Pulver. That's his thing. That's his thing. So if you guys are into butterflies, that's his thing. I'm a meat and potatoes kind of guy. I'm into the debit spreads, two debit spreads, credit spreads, basically iron condors, and straddles and strangles, which are pretty much the same thing, and time spreads. That's it. That's all I do. Yeah, and when Matt doesn't listen to me and does strategies that I don't like, This is what happens. See this? No respect. This is what happens. Right, Matt?
That's right.
That's why he's so quiet. He's learned to behave himself. All right. So let's continue. Okay, now this stock is really bearish. So the one we looked at before, this one right here, was sort of bearish. But this stock is really bearish. So let's say this stock is really, really bearish and seasonality is really, really bearish. What would we do? What would we do? Yes, we would just buy a put. And what would be the delta of that put that we would buy? Exactly. I've taught them well. Okay, let's continue. Now, and by the way, those were all the stocks on my short list. So TTD, Kava. I really like this TTD. And you know what? Kava may be a good. I'm going to make a note here for maybe end of day Kava and TTD straddle strangles. See, because this one has really good ATR too, and the options on this are pretty cheap as well. So theoretically, you can buy the 67 put, and you can buy the you could do the 68 call. Okay, yeah, you could do the 68 call. Yeah, about the same thing. If you can get this for like 50 cents, if you can do this for a dollar or a dollar, the entire thing for about $1.25, ATR. The general rule is I like the ATR to be about 3 times higher. Okay, than what I'm paying for the spread. Okay, you trade them together. Okay, now let's do the long side. So FMX, I gave you FMX. That's a very bearish stock. I would just buy a put on this one. Another one, HRB. I wouldn't do anything on that one. And it's too choppy too. Okay, now let's do the same thing to the long side, okay? And I'll give you a couple there. Amazon. So I find it really interesting. Don't you guys find it really interesting that today we had the worst PPI report in 2 years and Amazon is up? I mean, wouldn't that be like, wouldn't it impact Amazon more than anything else, right?
Mm-hmm. You think?
Call me crazy here, but I mean, so I'm just not seeing it. I'm not seeing it. Yeah, it looks very, very nice here. So let's say and by the way, I like Amazon right now. I do. So let's say seasonality is neutral on Amazon, which it is right now. What would I do? And I'm not necessarily thinking we're going to go much higher than this. I'm only thinking we're going to go up to basically what I think is we're going to resume this trend again. So it's just going to basically, let's just say it only has about $5 in it. What kind of a trade would you do? And this is an actual stock on my watch list. No, I would do a debit spread. And I would cap myself right here, 235. So what I would do is, because as we said, we don't think it's going to go too far above 235. So there's 2 ways we could do it. So let me give you the scenario. So one scenario, we can go about 8 days out. Okay. We can buy the 230. Or we can buy the 230, 250, and we could sell the 235 because we don't think it's going to go above 235 anyway. So in our analysis, and I hope you guys got out of that Russell trade that I told you about a little earlier. So we would pay for this about $1.80-ish, $1.70, right? No, excuse me, about $2, and our profit potential is $5. So $3. Yeah, so this is good. So you can do this, or you could do 232.50 versus 235, and you can pay about $1 for this, and then your profit potential is $2.50. But all we're looking for is a move up here. So you don't really need to you don't need to buy a 3-week out call at 0.70 for $18. That's $1,800. Okay? You can instead go right here 8 days out, go buy the 232.50 and sell the 235. And if Amazon goes up $5, this will go up 50%. And you spend $1.05, whatever. It's pretty good. Or because I said we're not expecting a big move, you could do the opposite. You go to puts, okay? You can go to puts, and you can then go 8 days. In this case, I would go a little further out. I'd probably go about 15 days out, and I would probably sell something like this or something like this. But I would need, the problem is, I don't know if I can get, remember, if I'm selling premium, I want to get 40 to 60 cents on the dollar, right? Otherwise, I'm not going to sleep at night. And if I'm not going to sleep at night, Clyde's not going to be happy. Yeah, you're right, Cyrus. Spreads do work better in this market because we don't have a clean market. We don't have a clean path. So my point in saying this is you could do a bear call spread or you could do a bull put spread because, as I said, seasonality is neutral. But I don't know if your risk to reward is going to be worthwhile on the put side versus the call side. I think the call side is good because the options are pretty cheap right now. And generally speaking, premium is cheap right now. Implied volatility is at like historic low right now. We're at new highs. So, or at all-time highs or close to it. So my suggestion to you is to do the 8-day call side, the bear call side. That's what I would do in this case. You could do Iron Condor, but I don't know. I mean, this is pretty bullish here. It's got a gap here. It already gapped there. It filled this gap. This is pretty bullish. And the fact that it's up this much after today's report, that says quite a lot. That's very, very loudly speaking, okay, in my book. Okay, let me give you a couple of more, and then I want to do, today's going to be the last day I do the seasonality class. The deal expires tonight. We're going to do that in a few minutes. Matt, can you usher everybody from the YouTube channel into the Zoom room, please? Yep. And folks, once again, I want you to understand, and I want you to know that the seasonality, you see how we used seasonality not to give us the trade, but to tell us basically, okay, now it's time. It doesn't tell us what car to drive, but it tells us what gear to drive the car in. You understand? No, I wouldn't be doing any Iron Condors on Amazon right now. So let me give you the rest of the stocks let me give you a couple more. So Z, let's do a couple more. I mean, I'm having a really good time. We're getting really good feedback and emails. Raleigh, any questions that I should be answering, or people are taking care of themselves?
They're taking care of themselves pretty well. There are some questions that came up. For example, Bob wanted to know, he said, hey, if the Vold was still going down, why exit IWM?
Because I saw because I'm seeing the S&P 500 and other indexes starting to uptick above the VWAP.
Yeah.
And that's going to bring buyers back into the market.
And then Bill had another question, and it's a logical question. He was saying, why do we lose money if the stock keeps on going up a lot?
I'm sorry.
And I think we probably need some context with that.
I'm sorry. I don't think I understand. I don't think I understand that question.
Yeah.
You can always email me, guys. You can always email me, roger@rogerscott.com. I love answering. I'm home alone till tomorrow morning. My wife is still in up north. So I'm not, Clyde and I are not that busy.
He was talking about a calendar spread. He was going, why do we lose money if the stock goes up a lot on a calendar spread?
Why do we lose money? Oh, because the short side is going to be worth money. It's going to be in the money. Then look, let's go back to Cisco. So let's say you do the Cisco calls, right? And let's say let's say we sold the 71 call like we did. And let's say we bought the 71 call, sold and bought, okay? Just like we discussed. Well, let's say Cisco gapped up and opened up $5. Your 71 call would be in the money. This would be bank. This would be pure premium here. We'd have to exercise them to cancel each other out or just offset them. But if you cancel each other out, they cancel each other out at 71 and you lose the 20 cents. Yeah, that's it. And you pay a fee for a dollar or two. It's nothing. All right. And that's anyways.
Yeah, and that was very specific to the calendar
next
spread.
week will go up. I understand what you're saying. My theory, I had the same idea, Bill. I thought the next weeks will go up even more. Remember, short-term options. Remember, if you buy an option on the S&P right now that expires today, it's cheaper, so the return on it is greater. I know what you're thinking. That what Bill is saying is, well, if this is going to go up, isn't this going to go up too? It will, but this one is going to overpower it because it's now and it's in the money and most of it is intrinsic value. So I know what you're saying, and I know what you're saying, and in theory it sounds right. But trust me, if it goes up a lot, if it goes up a little bit, you're right. This will still be a little higher. But if this thing bolts, no soup. This will always be higher. That's a 100% loss. Not a 100% loss. 100. It's a 100% fact that this will be more expensive. I wish it wasn't. I'm on your side, but it is. Okay. Sorry, Bill, but it was a great question because I had because when I think about these ideas, I'm also thinking, well, wouldn't next week's be more expensive? It has more time left. No,
Right.
because it implied volatility, baby. Implied volatility doesn't go down; it stays up. It stays at that 150 versus 50. That's the problem. Great question. Great question, by the way. Great
You
question.
bet. And the last thing that people are wondering about, Roger, very recently, they're wondering about the Amazon Bear credit spread. And they were just asking a little bit more on the
Oh,
details
the
there.
Amazon. Yeah. So let me
Yeah.
just go back here. I like Amazon right now. I'm really bullish on Amazon. I probably would give you this as a bonus spread, which I'm kind of doing right now. So you see right here, you can buy the 232.50 for $3, right? And you can sell the 235 for $2. So that's a dollar out of your pocket, 97 cents out of your pocket, a dollar out of your pocket.
Right.
And your profit is $2.50 potential, and you spend a dollar. So you still have a dollar and a half on top of the dollar that you paid to make money. That's 150% return.
You bet.
Now I'm not looking for that. I'm just looking for Amazon to go up to $5 and for these two to give you about 25%. Kind of like the opposite of what we did today on the Russell 2000.
Hmm.
I mean, it's exactly the opposite of what happened on the Russell 2000. So instead of causing you to spend $3 out of pocket, risking $3 out of pocket, I suggest we spend a dollar out of pocket and have the same ratio of return. Okay?
Yeah.
So that was
Excellent. And
yeah,
I
that
mean,
was that.
unbelievable analysis. And the absolute last question I had here came from Tim. He
Yeah.
basically said, with regard to Kava and TDD, he says, isn't the ATR grossly skewed by the earnings drop? Would that be the key
Well,
driver in
that's
that?
another good question. What was it, Kava? Ah,
Kava and TTD.
well, no, because the implied volatility is skewed because of earnings. But assuming it was a time spread, in this case, we're looking at a 10-day ATR. So I'm going back 2 weeks.
Okay.
I mean, earnings will skew it a day, 2 days, 3 days, but not 2 weeks.
Right.
It's a 10-day ATR. Good question. Love good questions. Love good questions. It was 230, 250, and 235 iPhone. That's a good question. And
Fantastic. Yeah.
when I see implied volatility, when I see ATR really high and the options are really cheap, that's time for a straddle strangle time. So right here. So I like TTD because it was like a buck. But if I can do this, I don't do them till the end of the day, so I don't really care what happens with them right now. But I'll start looking at them around 3:30 because by that time these will decay a lot more, and we'll be able to buy them a lot cheaper. TTD already reported earnings. I don't do them before earnings. I do time spread before earnings.
Hmm.
Yeah. Amazon was 8 days till expiration. Okay, let me show you one more, and then I want to do this class. Okay.
Yep.
So Z. Now this is a drift. So let's say that the stock has this technical pattern, a drift higher, and seasonality is slightly bullish. Slightly bullish. What would I do here? What kind of a trade would I do? What kind of trade would I do? We're going to do something now. I'm just saying, what type of an option strategy would I do? Seasonality is slightly bullish. In this case, because it's still very, very, very choppy, very, very choppy, and this hasn't broken out yet. This is a grind. If this is a grind, then I'm probably going to do a bull put spread. And I do bull put spreads all the time on grinds like this. You guys have seen me do it over and over and over again. Okay? bull put spread. If this was at a breakout level, if there was high volume at a breakout level, I would buy a call or do a bear call.
Hmm.
All right. A, yeah, bear call. Not a bear call, a bull call, a regular debit spread. But because buying the expensive one and selling the cheap one, or just a regular debit spread, favoring the call side. But because it's still drifting, and because seasonality is just slightly good, not really good, I wouldn't even mess with it. I would go right here to the 15-day, or maybe even lower here, and I would do a bull put. Okay. All right. So now, with all that in mind, I'm going to give you a class on seasonality and the tool that we. But you see how I wanted you to see with your own eyes. It was very important for me to make sure that you see with your own eyes how seasonality completely shapes the different type of trade that I may do at any given time. So I look at the technicals, but then I look at seasonality. And the seasonality, as I said, when you're drinking a Bloody Mary, seasonality is that thing. Seasonality is that thing that says, "Oh, I need a little more salt. I need a little more. I need a little more." Try drinking a Bloody Mary, a warm Bloody Mary without salt, pepper, or any of that stuff. It's going to taste like garbage.
Horrible.
You need all of those things. Same thing with trading. You need to know, is the wind strong? Is the wind weak? Is the wind favoring 15 stock? Imagine I go and look at seasonality, and every restaurant, I'm making this up as I'm going along, literally. But imagine every restaurant stock for the next 3 weeks has horrible seasonality. Just think about that for a minute, okay? Interest rates, PPI is higher. We don't know if rates are going down or not. Restaurants are definitely feeling the heat, and it's not a seasonally a strong time. That's a sell right there. So Dave says, really strong class today. Thank you. Well, if you like the class, please pay attention to this. This is the last time I'm doing this. And I'm going to be adding, as soon as Matt and I have time, the data into this program that will allow you to know how often, whether you can or cannot do a time spread. That data is not in here yet. We're going to put it in here, okay? And that's going to tell you, hey, you have the odds of a time spread in your favor, or you have time spread in your favor. We're going to be putting that in here very shortly, and correlation matrix. So right now it's just seasonality, which I think is amazing, but it's going to be a lot more. Please listen to this. Now, what I'm going to do right now while I'm doing this class is I'm going to give you a bunch of dates. Write these dates down. These are actual seasonality dates, okay? Now, what you may see, you may lose money, make money. Disclaimer, I'm not going to guarantee